I'm realizing this is probably like the most sobering episode we've had. So maybe it's maybe it's a sign of the bottom. I don't know. Hopefully.
Yeah, hopefully.
One, two, three, four.
All opinions expressed by Chris, Michael, Zach, and their castmates are solely their own opinions and do not reflect the opinion of 5i Research. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the 11th episode of The Exponent with 5i Research. My name is Chris. I'm the head of research with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. So today I'm joined by my co-host, Michael. Welcome.
Yeah, it's nice to be here with you.
Yeah, thanks. I'm glad that you can join us. And so it's been a bit of a roller coaster since our last podcast episode in early March. I think at that time we were kind of mentioning that things seemed a little bit frothy, but right before that, the markets were holding up okay, but then they kind of seemingly collapsed after that. The markets have really declined about 20% or more peak to trough. This came amid high proposed tariffs from the US and in general, just a lot of economic uncertainty. There's been a lot of fears that we could be heading into some sort of global recession. And on some days, we saw the global markets dropping in the overnight sessions, lots of limit downs, so where the market had to be halted. There's been a lot of news flow to keep up with just on the political side, as well as even company earnings. And I think a lot of investors are concerned about the economy, but also uncertain of like where to invest in or whether they should invest right now. So, another piece of what's going on right now that's really clouding everyone's kind of judgment and investing kind of thought process is, if Trump were to suddenly announce that, we're dropping tariffs or there's been some deal with China, something like that, that would be like material change in the current narrative. A lot of this current market pain can really go away like almost immediately. So investors have a lot to really consider and kind of grapple with. With that said, like, how are you feeling about the markets right now, Michael? And like, what are your general thoughts?
First, it is highly uncertain. This is the first time we experience something like this, like trade wars between the two economic superpowers. But at the same time, I also saw ton of opportunities, and I think if investors just keep their head down and stay focused on businesses and micro level, not paying too much attention to political stuff like that, investors should do really well 3-5 years from now, especially at these levels.
No, it's a really good point. Like every time something happens and the market goes into free fall and there's some sort of panic, we're always so micro focused on what's happening and what could get us out of it. But when we look and zoom out and look at the bigger picture, we've always come out of it on the other side. The market's gone up to all-time highs, and so it's really about positioning yourself into good companies and good businesses that you think can kind of navigate these sort of challenges and uncertain times. So with that said, kind of an agenda for today's podcast, we're looking at, the first one's going to be a look at the markets. So I'm going to be talking about just a few things about price action, kind of what I'm seeing in the markets. Then we're going to be doing Canadian small cap names. So Michael has a small cap name. I'll have one. Next, we're looking at one interesting ETF from Michael. Then investing lessons and mantras from Warren Buffett and Charlie Munger. And then lastly, guess that chart, where Michael will be presenting a chart to me. So I'm going to put this up. So these are some broad market stats that I've been watching, and just some things that we're seeing a lot of anomalies, a lot of outliers in the market right now. Things that are taking place in the market, which normally don't take place. And when they do, it's very noticeable to investors. So the first thing is we're seeing 20+% declines from all-time highs for the NASDAQ, the S&P 500, and the Russell 2000. So all three of those have kind of hit like bear market territory. The VIX hit 60, which is a really rare occurrence. We've seen that like a handful of times over the past decade. Credit spreads are widening, so that's kind of a worrying sign for corporate borrowers. And then we're seeing, oil to new lows not seen since last seen since 2021. Investor sentiment has severely soured. We're seeing US dollar weakness, which is really interesting. Inflation readings recently for the US have been coming in like ice cold, both on PPI, CPI. Stock breadth has collapsed. So that's kind of, the percentage of stocks that are either above some sort of moving average or just up on a year-over-year basis. And then the bond market was teetering. There was some issues going on last week. And the Fed kind of mentioned that they were there at the ready, just in the event that anything happened, they would kind of step in. So I'm going to look at a few interesting stats and charts that I found that have really kind of helped me navigate through this market. So this is the S&P 500. That's its price in the top panel. In the middle is its daily price change, so positive and negative. And then the bottom panel is its drawdown from all-time highs. And what we can see is, the first thing I want to point out is the drawdown from all-time highs. So we hit about 20%. And, we kind of saw that take place 2022, 2020, 2018, and then a little bit, like to a lesser extent, 2015. I think it was a 15% drawdown. 2018 hit about 20%. 2020 was worse, probably about 30% or so. And then 2022, just a little bit worse than 20%. But we can see that these instances are spread out over time. They don't happen too often. But when they do, usually we return to all-time highs in some sort of fashion, whether it's a V-shaped recovery or if it takes a little bit longer and it's kind of like a U-shape. So that's one thing that's interesting. Doesn't necessarily mean that we've bottomed, but at least it's important to note that these happen from time to time, but they're also not too frequent, or at least they shouldn't be. Then next we have, the market's worst days and its best days are often clustered next to each other. So last Wednesday, I believe we had the plus 12% day, which was a massive day in the markets. I mean, Apple, some other stocks like that were up like 16%, 15%. Lots of stocks were up double digits. A pretty wild day for the markets. I think I saw almost every stock in the S&P 500 was positive on the day, and I haven't seen that too often. So, and then, the following day we had almost a down 7% day in the markets. So it really goes to show that, the best and the worst days are often clustered next to each other. And so that's kind of something that's interesting to note. And that's what, market drawdowns are usually associated with volatility. So that's exactly what we're seeing here. Breadth washout, we're seeing, stock breadth being absolutely washed out. We're seeing, 40% of the S&P 500 constituents hitting new 6-month lows. So we kind of saw that last hit in 2022. It wasn't the exact bottom, but it was around like that June, July kind of low. The market went on to make a slightly lower low in October later that year, and that was kind of the bottom. But that was pretty much the bottom for 2022. And we're hitting that now. And I think what's interesting about us hitting that stat now is that this has been like a really rapid 20% decline. And so that's why I think a lot of stocks, almost half of the S&P 500 names, are hitting new lows over the past 6 months, is because this has been so drastic. And then lastly, some VIX stats. So I covered this in one of the TSX weekly wraps that I did. But this is the forward returns for the S&P 500, the forward 1-year returns plotted against the VIX. So whatever point it closes at. So along the bottom axes, we have the VIX close. So as we go to the right, that's like a high VIX. And then up and down is the forward 1 year return in the S&P 500. So up is positive and down is negative. And what we see is when the VIX closes above 40, historically, almost all of the forward 1 year returns in the S&P 500 have been positive. There's been about 8 instances since 1990 where VIX close above 40 turned into a negative forward 1 year return, like 20% or less. But it's outweighed multiples to those instances on the positive side. And we see a big clustering around 20% forward 1 year returns. So this is a really good sign when we saw the VIX above 40. And when we had that massive VIX spike, that was really signaling like there's a good chance that the forward market returns are going to be positive here, just given the historical data and how volatility usually is associated with massive sell-offs. Now we have come up from there from that point today. The VIX is around 30-ish today, so the stats are a little bit different, but that's a really good signal to me that things were heavily sold off. We saw breadth sell off, sentiment's bad. The VIX is high, uncertainty's there. Like a lot of these pieces are coming together that are usually associated with like major market bottoms. So I think to me, that's a lot of the kind of data and stats that I'm looking at. We could see another low. It's very possible, but I think for me, this is a really good spot for like a long-term investor. That's how I'm feeling about the markets. Yeah. There's
Very
a
good
lot
point.
to digest there. Yeah.
Yeah, sure. No, I have a few points that I found really interesting. So, like you mentioned, volatility, like the VIX, like it shot up to 60. I think in the last 10 years, it only happened like twice. This time and during the COVID. And so basically, like once every few years, kind of opportunities. Not see it very often. And and also you mentioned like the best days and worst days are usually like next to each other. So I think the lesson there is missing a few days, like last Wednesday when Trump paused the tariffs and the market shot up like Nasdaq shot up like 12% or something. Missing a few days like that could be really detrimental to like the investment result over the years. So it is very important that investors don't try to like dance in and out, just stay invested. Nobody knows when that would happen. Even Trump asked us to buy that morning and nobody basically did so. The last point is you mentioned about the 1 year forward returns for the S&P when the VIX hit above 40. I think that's really interesting. And of course, like nobody knows like where the bottom is, but it feels like we are close to a bottom than a top.
And
so stay invested, looking forward, and don't panic. And that's a few message from your presentation, I think.
It's so critical, especially not to panic and panic sell when the VIX. Like I think for investors, like if I had to say like one lesson for investors, it's investors don't have to buy when the VIX is really high and when there's as they say, like blood in the streets, but at least just don't panic sell, sort of thing. Just kind of like hold on to those high quality names because we can see the market move like extreme on those days, and you just don't want to be moving in and out because those sort of returns could take a long time to recover. So good point. So next we're going to be looking at some Canadian small cap names. So Michael, do you want to share your small cap name first?
Sure. So the small cap Canadian small cap name that I found pretty interesting recently is Pinetree Capital. The ticker is PNP. So it is an investment holding company that focus on owning enterprise software and technology publicly traded companies. And the interesting thing is the company is run by Damien Leonard. This is the son of Constellation Software CEO Mark Leonard. And the company follows a value investing principle approach and invests in a concentrated manner with a long-term mindset by taking minority positions in publicly traded software and technology businesses. And a few criteria that PNP tend to look for is portfolio holdings is the companies must be the providers of mission critical software, often like into niche markets. And PNP look for businesses that provide tools that are heavily embedded in customers' operations, pretty similar to CSU acquisition target. And this is mainly because these businesses tend to have really sticky revenue base and enjoy a really low customer churn. And also PNP tend to look for companies that are run by high integrity managers with a track record of capital allocation and efficient operations. And the interesting thing about PNP is the company has compounded book value per share at around 34% per year over the last 5 years, growing from like $3.40 in 2020 to almost like $8.30 in the most recent quarter. And so the company ultimate goal is to compound book value per share over time by invest in equity, primarily equity. And the typical number of holdings is around 8 to 10 investments. And the company has really high percentage of insider ownership. Basically 45% of total share outstanding is held by insiders. And also pretty similar to CSU, the total shares outstanding remain pretty much unchanged over the years. And here is a look at their PNP portfolio at the end of last year. So the company currently is 93% invested, mostly publicly traded securities on over the world. They have like a 7% position in cash. So some of the holdings is really interesting. They own like Topicus, which is a subsidiary of Constellation Software. And some of the holdings is, for example, Bravura Solutions is traded in Australia. And also some U.S. Publicly traded companies like TrueBridge. Basically, the two largest holdings accounting for like 45% of the portfolio. And this portfolio is at the end of last year. Things may change because market conditions has gone down a bunch, which they may deploy capital into new names. But that's the story of like the next quarter earnings. So PNP is trading at like 2.1 price to book. It used to trade at a discount, but the market recognized like the compounding engine behind it and bid it up to premium levels. So I think overall this could be a pretty interesting candidate as a long-term compounder.
Yeah, definitely. It's kind of definitely come onto the radar recently, and a lot of companies following that CSU playbook. But being the CEO of CSU's son, I mean, he kind of knows the playbook the best, and it is really interesting just looking at like that price to book, the book value per share, 5-year CAGR. Like, not only was it compounding at 34% on the 5-year rolling basis, but like it looked like it also accelerated from prior years. So their growth rate is picking up. And also, I'm just looking through the industries here of what their portfolio is, and it's really interesting that like they own a lot of really stable defensive type of industries that do well throughout most market environments, like healthcare, utilities, insurance. Those are really like stable, consistent sort of industries where you know the demand is quite stable. So that's really interesting. And then obviously operating in like software and SaaS type businesses, then the revenue is recurring and things like that. So it's a really, yeah, it's a really compelling, interesting story. And definitely going to keep this one on the watch list and see how it grows and kind of what kind of future investments they start to make and kind of watching their returns and things like that.
And then what's the name that you were talking about today, Chris?
Yeah. Yeah, for sure. So I'm going to be talking about Kinaxis. So Kinaxis, the ticker is KXS. It's a Canadian-based software company that specializes in cloud-based supply chain management and sales and operations planning solutions. So they have a platform. It's their main platform called the Maestro platform. And this essentially provides companies with end-to-end visibility across the entire supply chain, and their sales growth is pretty modest. It was around 13% last year. Forward sales growth is expected to be about 8 to 13% next year, but they're estimating to see earnings growth. They're expecting to see that accelerate around 20% plus. So they are seeing some like margin expansion there. They generate solid free cash flows. They've been repurchasing shares with this free cash flow. It has a high quality customer base, some blue chip names like Ford, Unilever, Qualcomm, Merck. And what I think is like really interesting about them right now, and kind of what drove me to this name recently, has really been the price action. So this is their price since 2014, 2015, and we can see that you know since 2020 it's really been consolidating in this like sideways kind of range, and it's been you know chopping around since 2020 in a sideways manner, and it's been holding up really well, all things considered, in recent weeks given all the market volatility. um, and so what we're seeing is also some valuation compression, and I'll show that in the next slide here. So the black line, this is its price chart. So we can see it kind of going sideways and chopping around. But then we have that blue line, and that's its earnings estimate. And we can see that earnings estimates have just been almost like skyrocketing. They've been rising quite rapidly since 2022, 2023. All the while price has been going flat. And so we're getting this huge PE compression where forward PE was over 100x, years ago. But it's come down to about 36 times now. Now, 36 times forward earnings is still fairly expensive, depending on the type of business and things like that. But we are seeing, kind of that price coming to the end of that, technical wedge and the technical pattern. And also, we continue to see its earnings rise. Its margins are expanding, and we're seeing just those analyst estimates kind of trending higher. And so I feel that, we have its earnings coming up soon. But depending on how things go with that, I think it's going to be really interesting to watch, like if it breaks out to the upside eventually, and, if its earnings continue to rise and price continues to go sideways, eventually its PE gets to an attractive level at some point where investors start to say, okay, this thing is cheap enough and growing at a fast enough rate that I'm willing to buy it up here. So I think that's interesting. And then we just have some general stats here on it. So we have, revenue, gross profits, its cash from operations, free cash flow, all kind of trending up and to the right, with some sort of seasonality and fluctuations, but largely this is an expanding business. So I think it's really interesting to see, its price go sideways, and I think eventually that has to end.
No, really, pretty solid name. Like I think we owned it for the growth model portfolio for some time.
Yeah.
Yeah. So a few years ago, it was like pure growth story, like focus on like 20+% top line growth, but the growth slowed down in recent years, and I think like the company now like start to optimize profitability. So like in the last 2 years, like they generate a bunch of cash, free cash flow, and last year they bought back a bunch of stocks. So I
Yeah.
think for a SaaS software that is expected to grow like double digits, like for foreseeable future, I think the valuation is still fair, and yeah, it's especially like the highly recurring revenue profile. This is a very attractive company to own in a volatile market. Um, yeah, overall, I
Yeah.
think this is a pretty solid name to own in this high volatility kind of market.
Yeah. Yeah. No, it's true. Yeah. And like another piece that you mentioned was their share buyback policy. And so, if we continue to see them buy back shares, that kind of helps the PE compress even more in conjunction with like their earnings rising while price stays flat. So I think, yeah, this could be a really interesting name and one that, I think enough people have kind of waited it out. A lot of people are losing patience on it. But I think eventually this thing moves and people will kind of start to hear about it a little bit more as that happens. Okay, cool. So next up, we've got one interesting ETF. So Michael, what interesting ETF do you have for us here today?
So today, the ETF that I want to talk about is the Chinese technology ETF, KWEB, KWEB. Uh, and first, let's talk about like the current landscape of the Chinese technology sector overall. So in the last 2 decades, China's economy has witnessed some of the strongest and longest streaks of growth, basically in modern history. Like the country has transformed itself from uh, uh, just a manufacturing focused country to like a superpower, and they produce some of the like leading tech companies in the world. Um, However, like the growth of the Chinese economy has been quite sluggish in the last few years, driven by a few like macro factors like a depressing housing market and a weak consumer spending environment. China also came out of COVID pandemic much lower pace than Western countries. And on top of it, the trade war recently with the U.S. Also put tremendous pressure on the country's growth prospect. Um, so these negative factors are really a huge headwind for Chinese equities, especially the technology sector. And to tackle that, the CCP has applied like various measures like monetary stimulus, financial market support programs to stimulate like the economy and the capital market. Um, for example, some of the policies of the CCP was to guide the banks to provide loans for publicly traded companies to buy back their own shares, which benefit like shareholders and provide liquidity for investors. Uh, in effect, the government is trying to boost the share price of publicly traded securities by providing funds and encouraging public companies to return that to shareholders. Also, China has taken like other methods to stabilize the stock market and discourage short selling. Um, so these are pretty much unprecedented move by a government, especially like from a country like China. The last time the U.S. market experienced similar stimulus programs of this magnitude that was supported by the government was back in 08, 09 during the height of the financial crisis. Um, and the US market, since that stimulus program in 08 has turned into a secular bull market lasting for more than 15 years. So I think the current setup is quite attractive for Chinese technology landscape. And some of their KWEB largest holdings include dominant Chinese tech companies like Alibaba, Tencent, Baidu, Pinduoduo and Meituan. These are like Amazon, Meta, Google, and Uber versions of the Chinese economy. And also, on average, the Chinese companies not only grow faster, like have stronger balance sheet, but also trade like cheaper valuations compared to U.S. peers. And these companies are also like buying back shares like aggressively now. So yeah, I think it is a pretty interesting theme for investor to look at in this environment.
Yeah, it's interesting. Yeah, to diversify into the international markets and one that's kind of like, I mean, it got so washed out from 2021 and 2022, and we saw this, the Chinese stocks really like bottom, but they didn't recover like the U.S. Equity market did, even though, yeah, like you were saying, like China's been injecting so much stimulus and liquidity, it really hasn't rippled through to those stocks yet, but we are seeing, I mean, KWEB's positive year to date. It's up year to date. So we are seeing those positive effects of diversification kind of play in there. And yeah, I think especially with kind of this tariff, dilemma and kind of trade wars that we're seeing right now on the global stage, like I, we could see some of these Chinese names really start to get defensive and start to try to grow, and maybe the Chinese government does allow them to grow a little bit more in reaction to what's happening with the U.S. Whereas before they were kind of stifling the growth of those big monopolies like Alibaba and things like that, but maybe now we see them kind of want to play a little bit more ball and want to compete on the global stage. So, and next up, I think you have some investing lessons and mantras from Warren Buffett and Charlie Munger, kind of just in this like period of time that we're in, where it's really important to kind of remember those timeless lessons.
So given like the meaningful volatility in the market like recently, I think it is helpful to remind investors some of the basic but important lessons of long-term investing from like Buffett and Munger, uh, which I think could help investors like get through tough time and even take advantage of the drawdown. So the first one, like consider stocks as a part of a business, not just a ticker that moves up and down. So this is really like investing 101 lesson, but sometimes we need to remind each other that stock at the end of the day is a piece of the business, not just a ticker with a chart attached to it. So behind every stock, there's a real business, the underlying company with a different story. And if the underlying business does well, investors should do just fine over time. So that's one. The second lesson that I think is quite useful is always remember that Wall Street always say like there's always something to worry about. So imagine in a world of like more than 7 billion human beings, there's always something for investors to be concerned, like recession, inflation, pandemic, and tariffs, and cats and dogs fighting each other. And so and the beauty of great businesses is like these companies are highly resilient to the vicissitudes of the economy. For example, like Coca-Cola has been in business for more than 100 years through like multiple world wars, and they are still a pretty solid business until these days, and they basically sell the same products. Um, the next lesson is the classic one, like be fearful when others are greedy, be greedy when others are fearful. This is easy to talk during a bull market, but it is really tough to practice, especially when the market is under pressure. The stock market is really the only place where everyone runs away when things go on sale. Like in real life, people get more excited when their favorite jackets or shoes are on sales, but not for their stocks. So I think like we think like if investors like stocks at $100 a few weeks ago, they should like it more now at 80 or $70, not to panic selling. And the last lesson that I think investors can kind of remind investors is time in the market, not timing, is what creates wealth over time. So basically, everyone wants to try to time the bottom, but it is really hard to do it in reality consistently. Nobody wants to catch a falling knife, and humans tend to feel safer and more comfortable to act with the crowd rather than against the crowd. We think like being a contrarian and being willing to ride along with the market through thick and thin is a key formula to create wealth over the long term. Like if investors wait until everything is clear as day and night, the opportunities may not be there for them to take advantage anymore. So I think these are really simple but powerful lessons and extremely useful in the current market environment to remind investors.
Yeah, no, definitely. I love that. Yeah, it's these are all great lessons, and like everything that you added on is like really, really good points as well. Um, things that we're going through right now, and there's so much to say here. Like, but yeah, I think like one thing was when you were saying be fearful when others are greedy and greedy when others are fearful. Like, it is like such an easy thing for people to say and kind of repeat, but it's definitely a hard thing to do. But it's harder to know when those points in time are. And I think, right now we're in a fearful time, and I think investors, it's easy to get confused as to like which part of this is all fearful. Was it like the day before everything kind of crashed because there was some fear there, or was it the day things crashed, or is it today? But it's kind of like, I think it's all of these times put together. And then in the future, we'll be able to look back on it and be like, oh yeah, that whole month or 2 month period was like a good time to be greedy because people in general were pretty fearful. And one thing that, anecdotally I found is when a lot of people are talking about like lower prices and, oh, we just need to, go one leg lower, or, bad news is going to be coming out and bad earnings. So we're probably going to go down there. And everyone seems to forget about like stocks can go up in price. I think that's, for me, is a really good time to start getting really interested in buying, because investors seem to forget that like stocks can go up too. And that's usually when I find that stocks go up in price. And yeah, there's always something to worry about. That's really a really good lesson. And I found too that like when there's nothing to worry about, that's usually the time to worry about something. But other than that, there's always something to be concerned about. So it's really like just zooming out and ignoring a lot of that day-to-day noise. So I think, yeah, time in the market, and buying dips, buying when people are, fearful, and when the VIX is really high, and just kind of using all of those data points to help navigate like when there's fear and when there's a lot of uncertainty and pain in the market is usually a good time to buy. So yeah, I think these are all great lessons, and I'm realizing this is probably like the most sobering episode we've had. So maybe it's a sign of the bottom. I don't know. Hopefully.
Yeah, hopefully. Yeah.
Yeah.
Talk about
But
frothy
yeah.
market like last episode and the bottom this episode.
Yeah, that's how quickly it can change. Yeah.
Yeah.
Yeah. So these are all really good lessons for, all of us as investors to kind of remind ourselves about. Okay. And then next section, I think we have our last section for today is guess that chart. So Michael's going to be sharing a chart with me with no ticker, no name, no price, even just percentage change over time. So I'm going to try and guess it here. So we'll see. Oof. Oh.
The hint is like it's a US company.
Okay. I recognize it, and I definitely recognize like that that pattern. It's starting to look like Head and Shoulders there. I Is it like Interactive Brokers or something?
Yeah, that's right.
It is? Okay. All right. Okay. All right. That's a good one. It, on a price graph, it looks super choppy, but at least it's up and to the right. So that's good.
Yeah, it's a quadruple in the last 10 years something.
Wow. Yeah, that's good. All right, that's a good one. I like it. Okay, nice. Well, that's all for today. We hope that you enjoyed this episode of our podcast and learned something new about the Canadian and US markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like this episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and we'll see you next time.
3, 2, 1. Yeah.